Past experience basically is how many deals have they done? How many exit does it look like? How many deals do they currently have? What's the number look like? So this basically gives you a picture of whether they're gonna perform well on their next deal. And I'm definitely not gonna invest with somebody this is their first deal.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Welcome back to the Path to Passive show. Today we have a truly fascinating guest joining us. He's an ex-tech director with software engineering and data scientist background, invested in multifamily real estate in over 696 units as a passive investor, has built a sports card startup with a $350 million valuation with a capital M, 2 successful IPO exits under his belt, and over a $10 million luxury watch collection. His journey intertwines with finance and technology at its core. And all those fantastic things said, as he continues to transition and grow as an investor, his mission is clear: to empower others in their quest for financial freedom. So buckle up, because this episode is about to be packed with insights from the tech world, the world of real estate, entrepreneurship nuggets, and alternate asset investing. Frank Xia, thank you for being on the show and welcome.
Yeah, thanks, Steven, for having me.
Yeah, totally. I'm excited and pumped for you to be here. Tell us a little bit about yourself, your background, and some of your expertise.
As the introduction said, I have been working about 7-8 years in the tech industry, and I got a little bit lucky. I choose to go from smaller to smaller companies. So I had 2 successful exits from companies that went IPO. One is Uber, one is Open Door. And 3 years ago, I started with my people, a third company called Alt. I'm the founding members, taking care of the data side, taking care of the machine learning side, and we build up the system, we raise money, we build up the product, and we bring the company to 300 plus million valuations. And recently, I decided to become more focused on investing my own money because I enjoy the investing world. I like playing the numbers game a little bit better. And this is how I'm doing right now. And I enjoy collecting watches.
Yeah, there's so much to dig into here. I think one of the first places I'd like to go with you is to really understand the path from being in tech to real estate. I know myself included, this is, a journey of, so many ups and downs and windy road. Nothing is a straight path. So I'd like to understand, how did you come to really, get your aha moments into real estate? And it's multifamily for you, right?
Yeah. So it's an interesting journey. So I'm Asian, I'm Chinese. So, Chinese like buying real estate. So my parents has been doing this for a while in China, and obviously they made some fortunes out of it. So buying property and make money is very deep in my gene. And in the United States, you don't see people talk about this a lot, right? Especially in your tech world, everybody talk about, oh, I'm going to buy this Tesla. I'm going to invest in that venture capital. No, not a lot of people talk about real estate, even though they talk about, they just focus on their primary residence, right? Like Silicon Valley, even Seattle, Bayville, it's super expensive. So I somehow don't have the luxuries of being surrounded by these kind of people who talk about real estate. So I started to do something my own, which is super not optimized. So I have the intention a lot of like saving money. So when I first joined the company, I worked very hard and I save it. The first property I bought was a condo in San Francisco. And obviously from a hindsight perspective, we sold the condo at 15% loss. So I kind of lose all of my principles after the loan. But that was a bad investment, quote unquote. But that actually is the foundation of how I started buying properties. So the first one I bought was condo. And then I started buying another condo in New Jersey. Then COVID hit. I realized, buying condo is not a good idea because everybody wants to move into single families or townhomes. And then I started buying more remote properties like townhomes in Texas, townhomes in Florida. So we ended up having a few properties under our belt. I think 5-6 townhomes under our belt in Florida area. then I become because the more you deploy, the more bottlenecks you're gonna end up with.
Mm-hmm.
So after 5-6 purchase, we ended up with a bottleneck that the banks are gonna say, "Hey, you bought too much, and you don't have enough cash flow to justify your DTR, which is debt to income."
Mm-hmm.
DTI, sorry, DTI means debt to income ratio. Mm-hmm. It is basically a ratio of your income divided by your mortgage, and you have to satisfy that ratio is higher than 43%. But I was working in a startup, right? As a startup, most of your equity are RSUs. They are not evaluated as cash. So bank doesn't care about that. They only care about base salary, which is super low. So I kind of get stuck because I can no longer buy more because I don't have enough cash flows to cover. And yes, so then I think, okay, I still want to do this. A lot of people does that. How do I figure out a way out? So interestingly, I met a colleague whose husband is doing something similar about multifamily investing.
Okay.
And we talk. He's an operator in another tech company, but he happened to have a reason to deploy his money into real estate for depreciation purposes. So he is more like the GP who brought me into this multifamily world. So I invested. Yes.
So let's pause right there because there's a lot to unpack, and I really love it. Yeah. But I want to ask. So you started with doing condos first, and that's where you had got those under your belt. Did you buy one first for yourself, and then, or were they all just investment condos to begin with?
The first one is definitely for myself, right? You have to buy something for yourself, then buy something for renting. That's kind of just my family idea. You have to get something for yourself, then you start investing.
Sure.
So the second condo I bought was intentionally for renting.
Okay.
But I was not betting on the cash flow. I was betting on the capital appreciation. Because condo, it is almost not possible to have positive cash flow, especially in a bigger city.
Yeah, especially because of homeowners associations and all of that kind of stuff gets expensive.
And tax, right. Yeah. And also you can the rent to purchase ratio is just not friendly.
Mm-hmm. Yeah.
In a very high end world.
Okay, so you got a couple of those until you got to the classic example, right? You had you ran out of your own capital, basically starting to run out of your own capital, and you're talking about cash flow. And also the banks are probably, were they also saying that, you're taking out close to your maximum amount of loans as well?
Right. Yeah. The reason is that technically, if you are buying a home and you try to rent it, your income and the expenses kind of offset, right? Mm-hmm. But bank need that process to be established for 2 years in order to consider that income.
Right.
Otherwise, it just expense.
Yeah.
Because I'm buying so fast, all of the incomes I got from these unit doesn't get counted.
Right. Yep.
So on the accounting perspective, my income is so low, but my expense is growing and exploding, and they don't like that.
Because of the 2-year lag or whatever it is overlapping.
Right.
Okay. That makes a lot of sense. Thank you. And so your colleague's husband was doing some stuff on the multifamily side. And you said they were an operator, so they were also in the tech space?
They are a COO of a bigger company.
Okay.
They're just focused on operations. Sorry.
Got it. But he was focused on multifamily, and that's how you kind of got wind of some things and decided to dive in.
Yeah, it's kind of funny because usually people get into this category by mentors, right? He had another mentor that brought him in, and he kind of brought me in, and I'm trying to bring other people's in. So it's like giving down the road.
I love it. So how did that go? What was that? Is that where you kind of had some aha moment because you got to the end of your capital and the bank and the cash flow thing, and you thought, it's kind of like condos, but many units under one roof? Was that the aha?
Yeah. Yes, that's not hard. So it's basically you figure out a way to don't worry about the debt side, the banking side at all. And you can just put whatever money you have. It doesn't have to be your W-2 money. It can be any money, right? Okay. Even the money from your family.
Yep.
And it gives you positive cash flow, 5, 6, 7% a year. And you have and you don't have to pay tax on the year you're getting it because of the deferred depreciation
Yep.
perspective. So you are basically just making 5-6% profit on the cash you invested. So this
Yep.
is great, and it's not like stock market. You are not buying something for unknown, right? Because for real estate, the underwriting process is very standardized, and it is more predictable.
Hmm.
So you kind of know what you will be getting. And I like certainty because I'm already in a very uncertain world,
Yeah.
and I need a way to diversify myself.
Yeah.
So that's why real estate is a perfect game for me.
The stocks versus real estate and the returns and cash flow. I mean, that's a conversation all in itself, but I want to unravel the
Yep.
story here. And so it was seeing that there was multiple units under one roof. Was that one of the biggest reasons for multifamily?
Yes, it's just much easier because let's say in a single family, your vacancy is binary, right? It's either 0 or 1.
Right.
But in multifamily, the risk is smaller because your vacancy is always like a small percentage.
Mm-hmm.
So that's one benefit. Number two benefit is you have a scale, economy of scale,
Yep.
because if you buy a single family home, you have to find property management because my goal is not to manage the property myself. My goal is basically find an expert to manage it, right? So the expert can manage one property or he can manage 100 unit.
Mm-hmm. Got it.
So if you're buying 100 door or like a multifamily of like 100 unit, the scalability becomes bigger because you only need 2-3 people to manage 100 or 150 unit.
Right.
So you are saving a lot, and you can systematize, or you can make the process very cookie cutted
Yep.
to do things. So that's something I like.
Especially if there's the unit mix or the types of studio or 1 bedroom or 2 bedroom are very similar as well, right?
Yes, exactly. It's like software engineers. We want to build a software that scale infinitely. So I think multifamily has very similar concept.
Yeah, I think that resonates with a lot of us on the tech professional side because we want to architect, build it, and then deploy it and repeat, right?
Yeah.
I really want to get into how you built the portfolio of the 696 units, probably greater than that now. But the audience is tech professionals, right? And
Right.
I know that sometimes there's the things that happen, right? With we want to go do something for the first time or maybe the second
Yeah.
time. And one of the things I like to address and really talk about is, what skills as a tech professional do we have that are translatable into a new area? So I'd love for you to talk for, just a few minutes to, think about and answer what things did you do in tech, as a software engineer or maybe as a data scientist? All of these skills are very, the models, et cetera, are very similar. How did you take some of those and bring it into the investing world, the multifamily world, and which ones, maybe 1, 2, or 3, whatever come to mind, were applicable?
Yeah, it's a very good question. So first of all, I'm more focusing on data, ML, engineering,
Okay.
backend. So this is kind of my stack, and obviously management. So what I find really helpful is obviously the managing part, because management is about communications, accountabilities, right? Interview, identify people. So
Mhm.
just being able to identify somebody you trust to work with and see how their process look like,
Mhm.
that's a huge plus. And I'm a data scientist, so I'm very sharp on numbers. I think all of the software engineer, we are technically CS majors or math majors, right? So we are very good at numbers or algorithms.
Yep.
So being very number focused, objective focused is also great, because
Mhm.
investing all about objectivity,
Yep.
objectivity, not about subjectivities. Because to me, it's about numbers game, right?
Yep.
So I think if the number works, that's a good sign. I'm not gonna do something that just, I like real estate, but this number doesn't work. That's not my philosophy. So I would
Right.
say the communication part, the people part, and also the numbers part is something that we can borrow a lot from our experience into that.
Yeah, I love that. It's so key. And even if you're not a people leader or have leadership experience like yourself, the ability just to work with others and have those partnership skills, because if you're working for a company, you're not just coding in a vacuum. You're not just working in a vacuum. You do have customers, external or internal. And so building partnerships and also having that step-by-step process of looking at numbers, just like you said, gives us both sides of the brain, right? But all of those technical skills. And like you said, like build it once and then deploy it over and over and over again, right?
Yeah. Once you establish the process, I think the first deal is the hardest. But once you define your playbook, deal number 2, deal number 3 is easier.
Yeah. 0 to 1, right?
Yeah. 0 to 1. Yes.
Awesome. I love it. So let's get into talking about the portfolio. What did you do to go from that 1 or, 0, I'll say 0 units in multifamily to where you are right now? The 696?
Yeah, the 696. Okay, so just for pure clarification, I don't own 100% of the 696. It's not like I own like 100% of the company, right? So basically, I invested in 3 deals for the past 2 years. That is $200 each, and they add up to 696.
Perfect.
And I try to just chip in as much as I can, because the first deal is always the smallest. You own a small percentage of the $200. The second deal you chip more. The third deal you chip.
Can you talk about that? And thank you for clarifying. So as a limited partner, you've invested into these deals, and so walk us through the process of maybe the first or second, whichever example comes to mind, around how you invested those. What you were going after for your criteria, your buy box, right? And what it was like to go and actually invest in those. Maybe the market, deal, meeting the people.
Yeah. So I think the most important thing is to identify somebody you like to invest with. This is the most important thing, because real estate is a very operational heavy business. It's not like you buy and you forget about it. But I mean, as an investor, it is, because my goal is passive income, right? My goal is to deploy my money somewhere, it generate me income. But there are a lot of homework to do. If you just randomly find somebody online and to give him 50K, the chances you'll be getting a decent return is very small, right? So my goal is to find somebody, do upfront homework, study, and I can trust somebody, and I don't have to worry about my future investment at all. So that's kind of the strategy I'm going in. So the mentor I spoke with, he's kind of the person who brought me into this business. So obviously my first deal is with him. So I grinded him maybe like 5 to 10 hours before I seriously put money. I write him a check. So
you researched him for 5 to 10 hours?
I talked to him for 5 to 10 hours.
Got it.
Like, I just keep asking questions, right? We were both at San Francisco. We had lunch. After lunch, I grabbed him a coffee and I called him 3 times. I'm trying to just go over every single line, because this is the new business. I don't know, right? I mean, the number looks great. It's unbelievable nice. So I need to understand what's behind this, right? I need to understand what is fact, what is assumptions.
Yep.
So then you kind of get an understanding of how these 15% IRR or annualized return get calculated. And then you become comfortable. Okay, let's do it. So a lot of homework that's required to pull the trigger for the first deal. I think that's just educations.
Yeah, great. And even that itself is numbers and people, just like we were talking about as the theme, right?
Yes.
And so great call out. I just recorded one on an episode on going through the different parts about vetting a sponsor. What were some things that that you made sure you really wanted to look for? You said you wanted to like them, always important. You're going to be with them for years in this investment. But what were some of the other things that came to mind that you were checking off the box?
Okay, so this is not sorted. I'm just sorted out.
Totally.
I think number 1 is you want to make sure you like them, right? They meet your vibe, because we are I think software engineer are kind of chill people. We are kind of antisocial, right? Usually we don't go to office event or social events. So definitely my ideal GP will be something like me, who is super dedicated, careful, relentless in sense of like getting things done.
Persistent. Yeah.
So so this is like the bigger pictures. You want to make sure the vibe matches, right? So I talk to people, because like the first time you talk to somebody, you couldn't really tell if they're lying to you or not. But the more you talk to people, you kind of realize, oh, this person is not telling the truth, right? So the more people you talk to, the more filter the sharper the filter you have. So you will be able to identify if this person is trying to brag about something or he's just being genuine, right? So that part, it takes time to tell. So genuineness, vibe are the two like most important thing. And the reason it's important is that when things are good, everybody is happy. But these are the firewalls when I don't know, I'm not allowed to say it. When shit hits the fan,
go for it. Yes.
What will happen? Right? Yes. Because I see a lot of people, I heard a lot of people in this, because I didn't invest too much, but I heard that story in this community that most of the GP, meaning like the lead people who assemble the team.
Yep. The sponsors of the deal.
The sponsors, exactly. Most of the sponsors, they kind of don't care about the property after the acquisition is being done, because of the compensation structure is very favored at acquisitions, right? Because they have so little skin in the game, they don't really care if the deal goes well or bad. And if you invested in 2020 when the interest rate is low, you exit maybe 2 years afterward, which is 2022, everybody makes money,
right? And
everybody is happy. So these kind of ugly things never happen. But right now, the economy is so bad. I mean, not really economy is bad. The interest rate is so high that a lot of deals are really negative on cash flow because they have to pay a much higher interest rate. This is when you see people doing ugly things. And this is why the integrity part actually is important. Because if a person or if the lead sponsor is truly with high integrity, he will take full responsibility of the fact, and he will try to figure something to solve it.
Yep.
If the person is shady, he might just run away.
Yeah.
Like the worst case is he just lost the debt, but it's a non-recourse debt, meaning that the bank is not allowed to come after the person own asset. So he just lost whatever he invested, but the person already make a huge upfront money during the acquisition side. So this is super important. Basically, you have to make sure that the people are high integrity, and takes time to vet them.
I'm glad you mentioned that. There's a couple great things, and thanks for explaining the non-recourse loan of, it's only what some of the sponsors will put into that deal to begin with, which is separate than the residential side. But the points that you were talking about around, knowing, liking, trusting as the framework, right? Knowing, liking, trusting, and things around, what has their past performance been like, right? And things of that nature.
So that's number 3. I have 2 more things to go. I think number 1 is you look at their underwriting. Because the industry process is basically, they're going to be webinars. They're going to tell you, hey, this is what the deal look like. This is the number look like. And this is why we think this is number look like. So multifamily, especially the area I'm invested in, I invest in Class B, Class C, value add multifamily. This is a very standard industry, meaning that there are like a spreadsheet where you put in your assumption, you'll get your number out, right? So I actually pay a huge attention to the spreadsheet where the sponsor team give it to me, and I look at it. I'm trying to figure out what are they thinking they can give me this 20% return annualized. Right. I'm trying to poke holes. I'm trying to understand, okay, is this because of they are really doing a great job, or they are just expecting there's a windfall from the sky that the rent is going to go up 10%?
Sure. Yep.
So I actually turned on a lot of deals this year just because of the assumption are super aggressive. I feel like the team is not doing a lot to give us money. They're just expecting the market turns good so that they can magically make the money. But I don't think there's a free lunch out there. Right. I'm looking for the underwritings where the sponsorship team is really doing their own work and they're trying to give us a return.
Yeah.
Because you give them the money, or you lend them the money to do the jobs, right? So they should perform to make other people's money, not just expect on the market.
Right. It's show how you got those numbers, right? And looking at, and that's where, key pieces of the tech professional background is so key as well, because like you said, being able to look at all those numbers and poking holes, that's where that experience comes into play too. So
yes.
What's the third one that you look for?
Yeah. So just to add more on the previous one, it's like writing softwares, and depends on how many unit tests do you write, right? Do you write like a comprehensive unit test or just write one unit test? So it's something similar to interview somebody to see how discreet or how careful are they.
Yep.
The next thing is just background checks. You want to make sure this is not their first deal. You want to make sure that they have successful exit from their previous
Did you
cycles.
say background check?
When I say just like their past history. Sorry.
Past experience.
Yeah, past experience. Yes. Past experience basically is how many deals have they done? How many exit does it look like? How many deals do they currently have? What's the number look like?
Certainly.
So this basically gives you a picture of whether they're gonna perform well on their next deal. And I'm definitely not gonna invest with somebody this is their first deal. I'm not gonna put my money and my friend's money into a newbie unless there's special reason of doing so.
Right. Because that is certainly helps with the trust aspect, and not trust for the person like you talked about, but also trust that they can do what they say they're going to do. And it's that person and the team, right?
Yeah. They like the accountability is two components. Number one is they have high integrity of doing something. Number two is their ability, right? I can say I'm gonna do this, but what if I don't have the skill set to do that? It's a separate thing. You need to have both to get one thing done.
Absolutely. That's skill set.
And skill set.
And then also, the type of leadership qualities to take it where it needs to go, right? The values based, etc. So pivoting from there, I know that's something that, you're in California in Irvine, right?
Yes.
Or you said San Francisco before.
I moved from San Francisco to Irvine.
Okay, cool. So right now the portfolio is you have some in Texas.
Yeah.
So talk to me about how you've done investing remotely. And let me just frame this up a little bit, is that, we hear that real estate is local, and that's true, right? Around markets, around the team, and also the deal itself. But how did you go about looking at a market that's outside of where you live to look for deals and ultimately invest?
Okay. I think number one question is to really try to figure out real estate investment is local, this statement. If you are actively doing your own management, you have to be local. If not, the person who's operating needs to be local, right? So say, for example, if you want to just do a single family, you can either buy it next door and you kind of just manage it every day, or you can hire somebody to do that for you. So if you are capable of figuring out a system to have somebody you trust to handle it for you, it doesn't really matter which city it is. It can be in a different country.
Yep.
So I think the most important thing is basically to figure out a team who's okay to operate, which is the sponsorship vetting I was talking about. So that's the premises. Speaking of picking market, there are a few general rules of thumb. So number one is that you need to understand the principle of real estate. Why does real estate prices goes up? Because if the real estate price doesn't go up, you're not going to make money, right? So the only reason you are making money is basically, number one is from the rent. Number two is from the real estate price goes up. So real estate is a very supply demand thing, right? The more people want to move in here, the higher the price can go, the higher the rent you're going to go. If you, for example, Detroit is pretty bad, notorious about like people moving out, right? So you will probably foresee the real estate price there dropping because you have less demand.
Sure.
So the goal is to figure out a place that is long-term more demand, because the more demand, the higher you can charge the price.
The rent's
Unless the rent price. And also you have to make sure there's not a lot of supply out there. Supply meaning new homes coming up.
Amount of units available and
exactly
things of that nature.
Yeah. So we are basically just picking the area where there are a lot of population inflow and not a lot of land available.
Okay.
So for population info, there are basically two major components. Number one is, okay, what kind of career opportunities out there? What kind of job opportunity out there, right? Because Amazon is trying to migrate to, like, not really migrate, they're going to open multiple headquarters at secondary tertiary state.
Sure.
Cisco, Tesla, they're trying to build up their second headquarters at some cities.
Right.
So Walmart, same thing, right? So you're basically trying to figure out like the cities where there are bigger company moving in, because they're going to create jobs, right? And when people get paid, they're going to pay for the rent.
Yep.
So you're basically trying to identify city where the population is going up and the job opportunity is going up.
Right.
Or you just move to a place that people prefer to live there. Like, for example, nobody wants to live in Chicago in winter. I mean, not a lot of people want to live in Chicago in winters, right?
I know I don't want to.
I spent in Chicago for a few years and I kind of don't like it. But a lot of people want to move to stay in Sunbelt. Sunbelt meaning like the northern part of the United States, which
Texas,
is like Phoenix,
Tennessee,
Texas,
Florida. Yep, Phoenix.
Exactly. So that's usually the areas, or even California. These are the states that qualify that filter.
Right.
And then you're gonna figure out, okay, which part of these states are more landlord friendly. California is definitely not a state for landlord friendly.
Talk about that for a second. What does that mean? That's not something I've talked about in previous episodes, really. So how do you think about landlord friendly?
Yeah, of course. So basically, there's tenant and landlord, right? In a rental market. So you want to understand when something goes wrong, which party is law favored to? Is the law favored to the tenant or the law favored to the owner? So California is basically a state that the law is very favored to the tenant. So I heard bad story, like there's bad tenant who refused to pay rent and he's legally allowed to stay in the home.
Right.
And you have to pay a huge upfront fee to evict him after a certain period.
Yep.
And this is type of not the business I want to be in. I don't want the system is designed at the disadvantage of me.
Absolutely. Thank you for defining that. It's wild. So landlord friendly in that it's friendly for the landlords so that you as an investor and also a partial owner can have more control over this asset and property, basically, right?
Exactly. So Phoenix, Dallas, Florida, these are type of the market where the law is more favorable to the landlord. So that's another considerations.
Perfect.
Other than that, it's basically like you want to make sure you are buying. Like then it's more about, okay, which area of the city do you want to invest?
Drilling down.
Then it's more, yes. Then it's more about local. Okay, you want to probably buy at some places that have higher income, right? You probably want to buy at some places with low crime rate, or maybe at some places that have great schools, or proximity to headquarters, proximity to highways, proximity to shopping centers, etc.
Yes. So
recreational areas. This is schools. Yes. Yeah. So it's always like market first, city first, and then sub regions next.
Yes. Thank you. That is perfect for real estate is local and clarifying.
Right.
So that was the process that you were going to, and so from there, it's finding sponsors that or the sponsorship teams, right? The teams that look for multifamily assets there that to invest with and go through that process of the knowing, liking, trusting, like you defined.
Exactly.
So what next? How did you go about that next? You picked your markets, Sunbelt, landlord friendly, and that other criteria.
Yeah, and then you can either do two things. Number one, is just wait. Number two, you actively find more people who operate in that region. So it really depends on your appetite, right? It depends on your investment budget. How many deals do you want to invest a year? If you want to deploy a lot of cash, then you probably want to know more people because you want to bet small at the beginning, right? But if you just want to invest once, I would say then you probably just need to find one or two people and wait for their deals. So rules of thumb is that if you want more deal flow, network with more people. If you just want a small deal, you are totally fine with just stick with the people you identify.
But absolutely. But it's still good. Would you suggest still when you're starting out to talk to a lot of people just to let them know and introduce yourself so that you can get an idea of, more conversations to understand what's going on, right?
Of course, it's like finding a job. You don't like the rule of thumb is don't sign your first offer, right?
There you go.
So yeah. you want to shop around to see what's the market look like. Then you can benchmark the person you like to the market.
Perfect. Yeah. Great analogy on that, shopping around, because you have a criteria, a certain salary, certain things like that, perks, etc. So going to different places. Cool. What else in terms of investing, out of state or in other areas, do you want to talk about or mention?
That's pretty much it. I would say just I personally fly to the market that I'm about to invest. I will personally want to see what property do I want. I want to personally verify whatever the sponsor team said is true. So I actually fly to Dallas a lot.
Got it. Have you gone to any? I imagine you've been to conferences and stuff as well. Is that where you've met some of these sponsors too? Maybe in Dallas.
Yeah. So I actually is very active in this networking. I mean, I'm trying to be very active in this networking space because I'm pretty young on this. So I am in a local mastermind in Dallas.
Okay.
And that was pretty good. That's where I meet majority of my team because they're very focused on Dallas, right? If you happen to want to invest in a city and that city has a very small niche investing group, you might want to be there to find your networking opportunities. Perfect. And then I go to conferences like Best Ever, Raise Fast, Big Pocket, etc. I go all of these conferences whenever I feel I want to go. I always go there and meet with people.
Yeah.
Yes.
Yeah. A great tip too, where look for masterminds or even those multifamily groups in the city or based in the city that you want to invest in. That's a great place to go and initially get some of that initial networking, right?
Yeah. So that's like paying for education is a huge thing because in tech, you have some learning budget. But you're not allowed to learn in real estate, right? So usually when tech people go to tech conferences, it's always free. It's hard to put your own money to buy $1,000 ticket for real estate. And you just need to get used to it.
Yeah, I completely agree. You have to invest in that education and it just keeps steamrolling, compounding, right?
Yeah. I probably spent $100,000 this year on education on real estate.
I've spent a lot as well.
Yes.
Over the last few years, going from single family to multifamily, others, et cetera. Cool. So how are you thinking about, real quick, tell me about how you were thinking about your buy box, right? You talked about B and C value add. Just quickly go over what that means for you and why you like that.
So I want to use stock as an analogy because people are more familiar with stock. So if you go to a regular financial advisor like Chase, they're going to provide you a core and satellite analogy, right? Where the core is you buy major index like S&P 500 or QQQ, which is tech equivalent. And then you have some small bet, which is satellite, as you betting on small, like particular things. For example, Tesla, for example, Twitter, for example, whatever you want, but it's a small percentage.
Potential good upside.
Yes.
Potential.
Yes. So the goal is that diversification, meaning that you want to put majority of your money in less risky stuff. And you also have some upside on the betting. I see real estate being the same thing. If you see real estate as a category, you want to bet you want to put your majority of the money on some places that is like S&P 500.
Mm-hmm.
And
Reliable.
then you settle, yes, then you bet small on different satellite. So for me, Class B, Class A properties are kind of the core. And usually, by definition, Class A is kind of the property that is being built after 2000.
Mm-hmm.
Class B is kind of the property that's being built after 1980. Class C is more like 1970s, 1960s, and Class D like more worse, right? Obviously, the lower the grade, the older it is, the more risk it's going to be. But there will be more upside.
More deferred maintenance or more opportunities to improve it in a from a business plan perspective.
Yes. So there's no free money, meaning that risk always comes with return.
Yeah.
So if you want higher return, you might end up with taking more risk. So for me, my strategy is I want to ultimately deploy 80% of my money in real estate into Class A or Class B, because these are low risk, decent return. My goal is not to get rich on these deals. I just want allocations. And then I'll be betting different things. For example, I'll be betting Class D. I'll be betting constructions.
Yeah.
I'll be betting other type like storage, parking lot, mobile homes, ATM machines, etc. So this is how I think about holistically right now, because I think Class B is the bread and butter.
Perfect. Thank you for calling that out too, because and let's talk about returns just for a moment too. Not super specific any numbers, but I think your analogy and comparing some of the stocks also to real estate is, like how to, just in general terms or however you want to explain it, the type of returns, growth stocks versus what you see in returns, appreciation, depreciation from real estate.
So let's just use annualized return as this conversation, because I don't want to go deeper into like IRR, AR, etc. So annualized return is like on average how much percentage of the money you're gonna make a year.
Mm-hmm. Mm-hmm.
So SPY, so I see stock market like SPY, like SP 500 is the most significant representation of the stock market, and that probably give you 30% a year if you look at the past 30, 50 years. So stock market 13%.
13. Mm-hmm.
13-ish. I want to look for something similar in real estate.
Mm-hmm.
So my expectation, because in multifamily, there's GP return and LP return.
Right.
And just for a short description is that GP is going to make money, but they're also going to take some sweat equity, meaning that they spend their time to get this return. So they're going to take a cut. It's similar to PE or VC model, right?
Mm-hmm.
So I'm always looking for the money that ended up to me.
Yep.
And I want that number to be at least 15%.
Perfect. So
that kind of analyzed to SP, but I'm a little bit more greedy on the real estate side because I know I can use my skill set to get better return by doing underwriting myself.
So you're looking for comparable returns, but I think there's a key thing here too, right? That even though that's the return rate that you're looking at just on that metric alone, mm-hmm. for the sake of this very brief conversation, but there's also things that you get to share in, like depreciation and appreciation, yes. And also when the asset sells, then you get that return back too, right?
Yeah. So the benefit is basically you have a lot of tax benefit out of it. You don't have mm-hmm. to really pay tax for the first few years until the property gets sold. But you can find ways to also defer that tax by rolling your money into another deal.
Totally.
So that's the benefit. But the downside is liquidity. It's not like stock market. You can sell it tomorrow. Right? You are basically stuck in this money for 3 to 5 years until they sell the property. So I'm definitely not going to spend all of my money into real estate. I'm going to spend the money that I'm comfortable of not touching it in the next 5 years into multifamilies. And then in return, because I don't care about the liquidity, I might get a higher payoff.
Yeah. And that's completely tailored to and custom whatever the strategy is for that person. But I understand what you're saying.
Yes.
So
Yes.
I want to ask, because we only have a little bit more time.
Yeah.
Cover some really great topics. I'd be curious to know, given your background around maybe AI and real estate industry as well. Is there anything that you can talk about around maybe certain trends that you've seen with, and from tech software to the multifamily industry as well? I know this is something that there's so much coming out. It's such an interesting space, continuing to blow up. So you can talk about that for a few minutes. What are you seeing?
Okay, so for full disclosure, I used to run pricing at Open Door, which is iBuying homes at single family space.
Okay.
You can think about this being a small Zillow arm. So Zillow is obviously does a few things, right? It basically gives you Z estimate, which is the pricing side.
Mm-hmm.
It's a marketplace for broker dealers to find each other, right?
Mm-hmm.
And also Zillow tends to do iBuying business. That they basically use their own money to buy the property and then they fix it, then flip it.
Got it.
Zillow actually closed that business due to economic downturns. But Open Door is purely that kind of type. We buy, we flip. We buy, we fix, we flip. So I spent a lot of money. I spent a lot of time, probably 2 years to 3 years, figure out how to use AI to solve that problem. It's basically
do the price all the way A to Z, all the way through pricing the analysis and do the flip cost.
Yes.
Wow.
Yeah.
Okay.
Not really the flipping because you need to have humans on the side to do that.
Yeah. Okay.
But pricing side is me personally, I think I can solve it using AI because our goal was to price every single home in the United States.
Wow.
And personally, I think that can be solved using AI if you have enough data.
Right.
I don't think anybody has done this for multifamily for a few reasons. I think multifamily transaction isn't as frequent as single family, right? And a lot of transactions happen offline, meaning that you cannot really find a record of how much this property can sell. So you have to call them, hey, how much do you actually sell this property?
If you have the relationships with the brokers.
Yes. So I know CoStar, which is a data vendor, multifamily, they are doing a lot of things like that. But I don't think they are doing any AI stuff, which will be curious if they done it. I personally think that you can technically use AI to solve 80% of the underwriting. Because I don't believe in real estate that AI solve 100% of the problem. I'm more like AI solving 90% and then humans solve the rest of the 10% type of stuff.
Which is still way more than it happens today with spreadsheets and everything else.
Yes. Because right now I have to spend an hour or 2 hours to fill out the spreadsheet and check all the assumptions and then check the numbers, right? If AI can grab the numbers for me and highlight, okay, this number, okay, this is what the market says, this is what you put, it's going to just solve so much of the thing. And then I decide what number goes into the cell.
Right.
So that's I think that's I see there are a company that's doing this. Like I see like few tech company that's doing this underwriting AI. Maybe I should start a company of doing that too.
I'd love to have you back on the show to talk about some of this more in depth. It's a fun conversation.
Yeah.
But I mean, we could talk about this for a lot longer. But I mean, I've seen, more and more tech come into space of, removing some of the people on site for doing leases, right? Smart homes or smart, systems and units, all of that kind of stuff.
Yep.
Anything else that you wanted to mention on this topic?
No, I just think AR is definitely gonna make the process much streamlined.
Yeah.
Because I personally believe humans are noise of the system. Humans are always biased. And humans makes mistake, machines does not. So most of the things should be handled by machine if possible. But again, real estate is a very high operational business. So human that have to be the last line of defense. You cannot have machine to fix the toilet for you. You need to find a contractor to do it for you.
And that's always what it is, even with the ML models all the way through to, right? Augmenting. So talk to me, man. What is going on with this, your sports card startup and these luxury watches? Just tell me a little about this sports card.
It's just a hobby ended up with a business. So 3 years ago, Trump administration, printing money, everything, and people just have a lot of money. So we kind of tap into the business of alternative asset. And everything has become crazy. Like, for example, cars, just like sports cars. Like the Ferrari is costing a lot of money. Right? Like you have to pay 50 grand, 100 grand for like Ferrari or a Lambo. A similar story, like similar situation happening in watch industry and also cars industry. So there are two separate things. I'm a big watch fan. I like collecting watches. And I feel like, okay, by trading watches, I can build up a huge portfolio at very small cost. This is how I end up with my huge portfolio at current level using a very small amount like money just by pure trading.
Awesome.
That's just my own hobby. But me and my friend, Lior, he's the CEO, we started a company called Alt, which is dealing with sports card, like the physical cards.
Yeah, I saw the sports cards on there. Yeah.
Yeah. And we are currently building a marketplace for sports card.
Love it.
You can think about this being a special eBay just for sports card.
Why sports cards?
I'm actually not a sports card person, but I like alternative asset in general, and I'm good at pricing. This is how I choose this category. I think sports card for two reasons. Number one is Lior, the CEO, he's a big fan of sports card.
Mm-hmm. Okay.
Number two is that the TAM, total addressable market for sports card, is like billions.
Yep.
So this moves us into that category. And we were actually with the mission of doing all of the asset. It's just the current market that we have to be super focused on the sports card area.
So the gentleman, your partner, he knows the industry, and he knows that the trading volume and just we'll call it market cap, whatever you want to call it for sports cards. And with your combination of knowledge of that trading volume and your pricing expertise and just tech professional background, it just was the perfect storm.
Yeah. And also it's just not me and him. We are like 5-6 of us assembling a small team, and then we build up 2 more people.
Love it. And just quickly in, less than 60 seconds, where do you want to go next with that? So
for sports card, I think my goal, because I think right now the company is pretty stable, right? Operations, because it's already like, it's not plateau, just like stabilized a little bit because market is going down. Our goal right now is trying to survive and beat the market and be profitable. So I think right now, the next few months of our company strategy is trying to be profitable.
Yep.
Meaning that we shouldn't burn more money than our revenue.
Totally.
And we also want to simplify our operations. There are a lot of inefficiencies of tech company when the company trying to grow a lot, right? So it's operation and simplification and make more money currently.
Perfect.
And for me, I'm more like, I want to just study investing real estate and keep deploying my money with my investors and also my friends.
Perfect. I've heard the phrase, the worst thing you can do for a passive investor is to give their money back.
Yeah.
Keep on deploying into new things. Awesome. A lot of nuggets in here. I really appreciate it, Frank. There's a couple things, if we could do just a quick rapid fire questions on these ones. What's something that you wish you knew when you were first starting out investing in multifamily?
No more people. I think people, I think I kind of pull the trigger when I just know that person. I wish I could know more people.
No more people. Got it. Expand the network, the whole.
Yes. I'm a very shy person. I don't like networking. And doing this business forces me to do more networking. So I think do more network with people, play the long game is something I would recommend people to do.
And find partners who can complement you, right?
Yes.
Okay, outstanding.
Yeah, that's part of the networking.
Awesome. What's something that you would tell new investors who haven't yet made their first investment that want to, cash out stocks or do have money already and they're looking to put their capital to work? What's something you would tell new investors?
Sell your company shares, because the worst case is you put all of the things in one basket and your company have to fire people, which including you, and company stock price drop 20%. That's the worst case. So diversification is the most important thing. So if all of your money is just in one basket, which is Amazon or Google, it's time to sell a bunch of shares invest in something else or just buy bond and wait for the opportunity. So I would say that, I would just urge for like, don't put everything in one basket.
Yeah, because I mean, for many of the tech stocks, they're not paying you dividends either, and they're definitely not giving you those benefits like you called out earlier.
Exactly.
And then finally, I know you're into personal development as well, which I absolutely love. I've read a lot of books this year. What's a book that has made an impact for you? It could be personal, professional.
Yeah, the yellow book at the back of the Who Not How. That's a very, I have a mixed feeling about this, but that's super helpful. But I also have my thought on that because so Who Not How is basically a book that talk about how to scale. Right. You it's not about you do everything. It's about you find somebody that complete something together so you can achieve 1 + 1 equal greater than 2.
Sure.
My take is that you cannot delegate something to somebody else fast if you don't know how it should be done correctly.
Yeah.
So for example, the book talk about, let's say, hey, if you want to do social media, you should find somebody who specializes in social media and do it for you instead of do it yourself. But what if I don't know what's the correct way of doing something? Mm-hmm. Then how do I know if they are doing a good job? Because there are a lot of conflict of interest in the business. So that book is definitely very inspiring, but my add to that is you need to know what's going to look like first.
I completely agree. The result is important. I think one thing that I took out of it, out of the book, it was very similar. And I've gone through this book a couple of times and also did the audiobook. And I'd wonder what you think about this part. Instead of going to the how component or doing all of the research on it, who could I go to that might be able to help me with this that might decrease my learning curve?
I 100% agree on that part. Mm-hmm. The hard part is it's very hard in real life to find the who. There are so many experts that claim they are expert. How do you vet them?
Sure.
That's a very universal problem to a lot of people. I can translate this to like, how do I find the GP?
Yeah.
Right? How do I find assistant? How do I find the CEO of the next company?
Mm-hmm.
It's all the same. You have to do your background research before you commit.
Great clarification. It's knowing what result you're after. And sometimes that takes that initial research to make sure that vision's clear.
Yeah.
Frank, thank you so much for being on. Where can people find you, and what are some types of things that, people would definitely reach out to you for?
I'm currently most active on LinkedIn. This is the place I post daily about career growth and money mindset. So follow me because I post daily, comment. That'll be the most. That means the world to me. I'm also building a website called Daytona Capital. I named it because I like Daytona. It's a Rolex watch. I like it a lot.
Love it.
Daytona Capital is basically a company that helps people to invest into real estate. And I'm trying to build up this venture.
Perfect. Daytona Capital to reach out to invest in real estate, and also go check out your LinkedIn where you post on money and money mindset daily.
Yep.
Is that right?
Yes. Yeah, that's right.
Outstanding. Folks, go check him out. Super excited to have you here, Frank. Thank you so much for your time and energy and spending your time with us. So talk to you again soon. Appreciate you.
Thank you very much, Steven. Talk to you soon.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.